Good afternoon, everyone. We also had a very inspiring fireside conversation that we just saw between Madhav and Mr. BVR Subramaniam. And I think it's truly set a powerful vision for a thriving restoration economy and a Harit Bharat. With that momentum, a very warm welcome to this session, the next session, on investing in tomorrow, unlocking private capital for landscape restoration. I'm Vibha Sharma, Program Lead, Restoration Finance at WRI India, and your host for this session. It's wonderful to see so many of us here who care about the future of India's landscapes and the millions of people whose livelihoods are rooted in them. We all know that restoring land isn't just good for nature. It's smart economics. Every dollar invested can deliver $7 to $30 in benefits, which means more jobs, incomes, livelihoods, stronger food, water, and nutritional security, resilient supply chains, and healthier ecosystems, the things that really matter to people. And just to quote Mr. Subramaniam here, none of this can be successful unless it becomes a people's movement. So it's really about what people care about. Restoration is climate action that people can both see and earn from. India holds one of the world's largest restoration opportunities, as we saw in the morning. There is no dearth of opportunity. In fact, the country holds one of the largest restoration opportunities globally. And with the right approach, this can also become one of our biggest investment opportunities. The government and philanthropy have laid strong foundations, again, something that we've seen, we've heard all morning. But to go from promising pilots to impact at scale, we need a bigger engine to accelerate progress, and that's private capital. Precisely what this next session is about. So the big question we're asking here is, how do we make restoration the next major investment opportunity for private capital in India? And what we'll also try to do is answer some of the questions, some of the reflections that were brought up today. For example, can private finance solve for the uncertainty in the availability of funds that Mr. A.N. Jha spoke about earlier today? Can it help solve for flexibility, for adapting to diversity in restoration? Can tying capital to economic activity ease the flow of money, right, and bring in more money? And also here to quote BVR sir, how can we decrease the cost of capital, right, to increase the flows? To help us unpack some of these questions, we have a wonderful panel with us today. And as I introduce them, I would request them to please walk onto the stage and occupy their seats. We have panelists from four different who bring four different vantage points today. The first panelist is Santosh Singh. Santosh is partner and managing director at Intellecap and leads its agriculture and climate solutions practices, driving climate and agriculture financing solutions that build markets for resilience. He has more than 20 years of experience in scaling up market-based solutions for climate change mitigation and adaptation. Welcome, Santosh. Our next panelist is Arti Dhar. Arti is co-founder of Farmers for Forests, an organization on a mission to protect and restore biodiverse green cover in India in close partnership with agrarian and indigenous communities, aligning community incentives with long-term ecological outcomes and demonstrating what works on the ground. And I'm sure many of us know Farmers for Forests very well. Welcome, Arti. Next panelist is Arun Krishnan. Arun is the Program Director for Climate Finance at WRI India. Arun brings over 15 years of experience in deal advisory, climate and project finance, and public-private partnerships in restoration, urban infrastructure, transport, and airports. Welcome, Arun. And finally, leading this conversation is our moderator, Vibha Sharma. Vibha leads impact financing at Villgro and has deep experience across the corporate and development sectors. She works to design and implement financial structures that unlock commercial capital for enterprises in agriculture, rural livelihoods, climate resilience, while using philanthropic capital to de-risk investments and drive impact. Welcome, Vibha. With that, I will hand over to Vibha. Over to you.
Thank you, Divya. And thank you, everybody, for joining us. So we're going to dive straight into the critical topic that we are addressing today, and the core question, which is both very simple and incredibly complex at the same time. Where is the money? and what is it that is stopping it from reaching landscape restoration at scale? So we've heard in the earlier panel as well, right, that landscape restoration is extremely important, and it has a lot of impact in terms of the social, economic, and community development in India. But in spite of, all the benefits that it comes with, we still see that private capital has been quite slow in terms of reaching these projects and, creating the necessary impact. So in the initial round, what we'll do is we'll try to understand from the panelists here, what is it that the investors are seeing? What is the trend that is there in the market? What are the communities experiencing? And what is really holding the capital back? So I'll start maybe with Santosh. Santosh, you're at the intersection of agriculture, climate action, as well as investment in these areas. And you understand what are the types of capital, which are flowing into restoration-aligned sectors, and where is it that the investors are hesitant. I'd love to kind of understand, your views on where is the private investment moving today, and what are the risks of or market failures that are holding this back. And while I, refer to private capital, I would like to also, mention that private capital comes with, different forms, right? Like some could be equity, some could be debt. So bringing in the nuances of these private capital, I think would be very useful for the audience.
Thank you. Good afternoon, everyone, and thank you for having me here. I think the sessions before this one, we have deliberated on the need for financing. And the question is, where is money? I think with the $400 trillion economy, global economy, we are talking about $700 billion to save the world. I think money is there. I would focus on why this money is not flowing. It's not a question of whether money is there or not. Money is there. It's a question of why money is not flowing. And just to put a perspective to that, I think we need to unpack what we mean by restoration. I heard our professor speaker in the session talking about different activities. And restoration is a very, very umbrella term for multiple things put together. And once you club so many things, you lose a lot of nuances. In restoration, there are several segments which have different kind of economics, different kind of values, different kind of price to those values, and different kind of returns that they can offer. And private capital is basically picking the one which are mature. When I say they are mature, they have technical maturity, they have business model maturity, and they have risk-reward ratio that is aligned. Take an example of in restoration, it is very easy to find investors for a project where you have an IRR in say 15% or plus low risk, plus ready market. But how many of these activities would qualify that? So when I look at restoration, I classify the restoration activities in three categories. One, which are having a lot of value to society, a lot of value to environment, but have poor market pricing. There's a complete market failure, where you are creating a lot of value, but nobody's paying for that. Those segments would always be the last to attract commercial capital. The second ones are that they are giving you value, the economics is there, the technical maturity is there, but the kind of risk is perceived in them is not attractive enough for private capital to come there. That's the sector where you need a lot of catalytic capital, you require a lot of risk mitigation, a lot of interventions to provide capital. Third one are the commercially mature segments where commercial capital is flowing right now. So agroforestry, farm forestry, many of these things, I'll touch base on this later, but if we unpack these in these categories, then it's easier to talk about the capital. While I would say that the presentation that WRI colleague did just before the session, you saw that the drivers of the restoration activity, you are saying, what are the enablers? Institutional enablers, communities, ecological, and there was one more, I'm forgetting, but just these words are not very exciting words for the commercial investors. If you see something so much complication that the communities are involved, you have to pick so many things, they try to see, okay, I don't understand this. And unless I understand this, I will not be able to invest. I'll conclude by saying that, we talk about mitigation financing, we talk about climate financing. Take about an example of solar plant. A solar plant works in the same way. in Africa, in Latin America, in, say, India, within India, multiple states. We know the economics, we know the technology, we know what it does. Replace that with a registration project. It's very unique, rooted into the context, the culture, the community, and these understanding right now don't exist. Until the time we get this completely, made open or find a way that this can be captured, commercial capital would continue to elude.
Great. So I think I totally agree that, when we look at, the three different categories that you mentioned, right? One where your impact potential is highest, but maybe commercial value is low. Second, where, the risk itself is very high, and hence, even though there is a commercial value, it is still not as attractive to the investors. And the third, where, there is kind of a convergence of, both the return and, the impact. And that's where, agroforestry and such sectors are currently, attracting capital. So I think that's a great kind of turning, segue into my conversation with Arti, who, at Farmer for Forest is actually working directly with the agrarian and the indigenous communities. And, looking at, I think you've been working on early stage restoration, and you have a lot of on-the-ground experience and exposure working with the communities, and it's a very, very different situation on the ground, right? And not one that a lot of investors do understand. So which means that, there is a lot of gap in terms of what is it that the investors are expecting, and what is it that the communities are experiencing and can offer, right? So from that experience, what are these biggest gaps, and, how can we, in spite of these gaps, get private capital to, kind of enter these sectors?
Yeah, thank you. First of all, it's very nice to be here. So I think, Vibha, to answer your question, I think I'll bucket it into sort of three large themes or categories. I think the first one is this sort of evidence-time mismatch. I think even today, it's not very uncommon that once we get funding, we'll get this really neat table from a funder where we are then expected to report on quarterly progress and updates. I think the good news is that the frequency of that has decreased. A few years ago, we used to get that a lot. Nowadays, we'll be lucky if we're expected annual progress and reports. But I think the point still stands that the default still is for quite a few funders to seek like quick, measurable, like linear results. But restoration is, biological, it's community-driven, and therefore non-linear. So, like trees don't grow quarterly, they grow in cycles. Soil health takes a long time to improve. We don't see any increments or any improvements in our baseline soil data, at least for a couple of years. And even like trust building with farmers, before the planting even starts takes a very, very long time. So I think that sort of, that compulsion sometimes that we see from funders that you have to report quarterly or every 6 months and we have to see some sort of measurable change is something that is just very, very hard to do in this space. The second is this idea of like bankability versus like ground reality. I think investors still often want these standardized, de-risked projects, from day one. But the on-the-ground reality is that, we work primarily with smallholder farmers. So we are dealing with fragmented land holdings. We work extensively in Maharashtra, and even within Maharashtra, we see immense variability in weather patterns, immense variability in even a community's readiness to transition to biodiverse agroforestry from monoculture farming. So like restoration projects don't like behave like, say, rooftop solar projects, right? Like they are definitely durable in terms of like ecological and social value, but they're very messy, they're very complex, and they're very hard to get off the ground, and especially the first few years are the hardest. The third category, or the third point that I want to make is this liability capacity mismatch, and I think this is a little bit more relevant to carbon projects or like carbon funded projects. We've seen that in most of the carbon projects, implementers like us are often asked to take on these like multi-year, multi-decade guarantees and penalties that no small or mid-sized implementer like us can take. So, you know, we've seen carbon investors asking us to guarantee like 20 to 30 year, you know, tree survival, you know, future carbon yield. They even want us to guarantee like community land use decisions, farmer land use decisions. So this level of liability simply like doesn't match the balance sheet or like risk sharing capacity of an organization like us. So we need to kind of change that a little bit, like, you know, kind of make risk sharing a little bit more equitable as opposed to pushing it downward. So I would say these are the three big categories in terms of like the biggest gap we see.
And anything specifically on the community lines as well?
As in?
Like the communities that you're working with for the restoration and all that. Have you seen anything from their perspective?
I think from their perspective, what we hope to see, or like that we hope will change a lot more, is the amount of carbon revenue that's being channeled back into the communities. So by the time everybody takes a cut, the percentage of carbon revenue that goes back to the communities, I would say optimistically, is maybe 15 to 20%, which is quite dismal.
No, thanks for that, because this is something that I've also been observing, you know, when we're working with the social enterprises at Villgro, that, you know, typically these businesses, these kind of solutions, even when they're not, you know, the kind that are related to agroforestry, where you're dealing with, you know, trees and carbon and all of that, it still takes like 8 to 10 years for, you know, typically such innovations to actually be in a position where they do not require support, right? Philanthropic support. There's always that mismatch between commercial and, you know, the project itself, right? Basically the commercial doesn't seem to understand the ground realities, and that's where the bulk of the problem comes from. It's more like, you know, a template that we're trying to tick off, right? To say that I want this from this project, but the fact that the project is not capable of that is not understood. So, point well taken. Arun, I'll come to you now. And you know, you've worked in your current role as well as in your previous avatar, you know, in terms of mobilizing climate finance. And you're familiar with what does it take to, you know, turn climate and nature-based action into investable opportunities. So from your point of view, what is it, or where do you see that is the strongest opening for private capital to actually enter into this particular sector and to engage in restoration today? And what do you think are the structural barriers that are preventing that from happening?
Yeah. Okay, so one thing which I observed, and you know, I've taken a few notes from the previous, from the CEO of Niti Aayog as well, that I think restoration has a marketing problem, right? You're not able to state the problem in a way which can be consumed by investors, right? And that, you know, if that is solved, I think, I wouldn't say half the problem is solved, but at least a good chunk of the percentage of the problem is solved. What is it? What are the cash flows? What are the returns? What is the time period for the returns, etc.? Those are some of the things which investors would be interested in. The second, I had a question as well, and I'm trying to answer that, is private capital required for restoration, right? Because of all the constraints and the concerns which were raised, is private capital really required? I mean, is it essential, or is it an add-on to what the government or the public sector provides, right? So I think right now the status is that it is an add-on, right? It can be a substantial add-on, but it can't be the core. The government obviously has to provide core of the capital. Partly also because restoration is a problem of the commons, right? All these landscapes which are degraded, it's a problem of the commons. I looked up some statistics. I think around 50 million hectares of land were reported as deforested and degraded. And for context, this is around 40% more than the area of Rajasthan, right? So Rajasthan plus 40% of Rajasthan. And we have committed to restoring around half of this by 2030. This was a target announced in 2019. Maybe there's an update on this, but this was, this is a few years old. We have restored around 10 million hectares, which is, 1/5 of what is actually degraded, while we are working on 25 million hectares. The cost to the economy or the gains for the economy was mentioned by the CEO of Niti Aayog, so 2.3%. So we can look at it that way. And that makes a case for government and public sector investments. Does it make a case for private sector investment remains to be seen. But of course, CSR is the most immediate entry point, right? Now, I think the numbers for CSR is around $3 billion or $4 billion, 30,000 crores is the CSR funding. Now, CSR wants a label, right? The private sector, which is offering the CSR money, they want a label. So the idea is can we create these pipelines of projects where you can actually put a label on it and say this company did it, right? So for example, in Gurgaon, they have restored a bandh, and Indigo has taken up, some other corporates have taken up, and they put a label against that, right? So that is one of the, you can say, the challenges of CSR funding. The other is, of course, ESG funding and corporate value chain investments. Now, ESG funding, there are two things here. One is the ESG mutual funds and so on, which are thematic investments. But this I'm talking about in the value chain investments. For example, PepsiCo has committed to becoming zero discharge, or it's already zero discharge, and so on, right? So you have these corporate commitments which can be leveraged. So you need to see themes which are related to restoration and go to those corporates. And I think, more than the ROI, they'll be looking at the marketing value of that, right? If you look at a label of a product, or if you have a company, and in their presentation they can say that we are working with farmers and we have restored X amount of land, then it would be a powerful statement for them. Off the top of my head, I can think of organized agriculture. For example, you have tea plantations and coffee plantations, which are already touting this as restoration as one of their selling points, right? I've seen labels on these more expensive Darjeeling teas, which talk about landscape and water restoration and so on. So I think this value chain pipeline, corporate value chain pipeline will be very important. Impact investors, of course, you have impact investors which have philanthropic capital, which have family office investments, which are looking at these sort of outcomes. They may not require a market-beating rate of return, but they are keen on these sorts of outcomes, and which India, I think, has given the potential of the problem. I just mentioned 50 million hectares. Given the potential of that, we can actually create a pipeline of products, showcase it to impact investors, and try to bring in investments, right? So I think, these are the, I would say, the lowest hanging fruits or the medium difficulty, ways to get private investments in this sector. And in terms of structural challenges, like I said, there is no structured pipeline. There is no, the national investment pipeline, for example, if you see, the national infrastructure pipeline, the website has a huge list of projects in different infra sectors. It has CSR projects also, okay, but it has very few restoration-related projects, right? So the pipeline building is one area where I think we can improve. The size of the project, right? I think what Arti is doing, she has brought in 10,000 farmers. So that sort of scale is what we are looking at, not 100 farmers or 50 farmers. So that would be one other issue. Complexity of land, of course, weak MRV, okay? So how do you actually measure the results and how do you showcase it to investors? That's another challenge. And of course, the lack of a facility or a window or a financing or a fund which can really take on these challenges, right? Maybe the government should create a facility which can pool in different sorts of capital, which can then be used for investing in these projects. So yeah, those will be some of the challenges. I will end here.
Thanks, Arun. So I think if, just to kind of summarize, this question, where is the money, right? I think we heard that money is there, and we also have additional opportunities for capital to kind of enter the space when you spoke about CSR, ESG, and, other impact investors. What is required really is, do we have the right projects that can be designed, factoring in what is the investor needs in terms of risk and return profile, right? Maybe there are certain projects which are not suited for private capital, but are more relevant for philanthropy as well as government capital. Second is, can we get the ground realities to be understood by the investors and, have that expectation mismatch being addressed so that, the capital that comes in knows what it is getting into, knows the kind of time frame that is needed for the change and the transformation to happen. And yeah, I think the last bit, which I think is really critical, and this again from my experience also in the last few years at Villgro, unless we are able to kind of create a strong narrative or a story of impact, it is difficult to get funders like CSR to actually come into the sector. They are looking for what they can put up saying that, we have been able to support 500 farmers or 1,000 farmers or a certain geography to be, totally transformed, right? So how we pitch our project to some of these funders, I think also becomes equally critical. And we have to come up with that narrative and say, this is what you're getting in return for your money, right? So that's the first piece of our panel. What we'll do is we'll move now into understanding what are these examples, because we have a lot of success stories as well, while we have seen the challenges in terms of what has worked, some of the pilots, some of the projects that have been implemented. And we'll hear from the panelists on what they have seen, which have been successful cases of land restoration. So back to you, Santosh. Intellecap has helped design innovative financing structures across climate, agriculture, and livelihoods. And, there's innovative financing, risk sharing, partnerships. So maybe you could walk us through a concrete example of where Intellecap has successfully enabled private capital to flow into a restoration-aligned project.
I'll broad base this, so I'll not talk about only Intellicaps, but larger
Sure.
so that we have a context to that. But also just to add on to the previous remark that I made, I don't count CSR as the private capital because this is a very different bucket altogether. Commercial capital is different. And I'll say that all the examples that I'm going to give and what we have done has only one line. It has made the investors understand the sector, reduce the risk, and make clear certainty about the revenues. So there are a lot of interventions around that they have achieved. So just starting from, back home here is NABARD has been doing this for quite some time. We often ignore, but NABARD has been doing a lot of restoration adaptation financing, and while they don't call it, but they are one of the OGs of the restoration adaptation financing. And we are working very closely with them to have a carbon fund that would finance carbon projects, not all kind of restoration, but carbon projects with debt capital that have a proven contract for carbon buyers. So that would unlock some capital there. It's going to be launched soon. The second type of thing we have seen that there are a lot of insurance products that have made private capital flow. So one of the critical things that happen in any sector, once you see the insurance product walk in, then the sector starts getting more and more attractive to the commercial capital. And I can give you a long list of the innovations in the insurance sector that have come to the nature restoration, right from destruction of coral reef being insured to the wildlife-human conflict being insured to parametric-based, different kind of insurance. They have all been there. Once these insurance products are leveraged, the products, the projects, the interventions become more attractive. So what we need to have is more specific insurance product to different kind of projects so that the commercial investors can. These insurance product could come from the philanthropy, from the government, or from any other commercial sense. Ideally, they start with the public money, commercial, and the philanthropy money. And that's a right way to unlock more capital per dollar of public money. So rather than you financing, you put an insurance that could unlock that. There are several cases of that. So that's a one way of insurance. And the second is that dedicated funds. Globally, we have seen Mirova, we have seen a number of, we had Acclimate having a number of funds. I don't want to name them, but if you look at that adaptation and restoration focused fund, these funds were specific to a particular thesis that will invest with this thesis, this economics in this region, and they have been doing that. The third dimension of these products is that you start to see that what are the kind of different activities and what kind of revenue metrics they have, and accordingly design intervention. I hear about restoration. One is surely about, if you're talking about agroforestry, you are talking about a horizon of 20 years. There are not many products that exist that can finance for 20 years. So obviously there is a need for having some kind of innovation, some kind of product fit. But there are several other activities, right? You do activity like water restorations. There is no way that you can have commercial investors because who is going to pay for the water benefits? There are no economics. So we need to understand that there are 4, 5 outcomes that we look. One, we have got a market, and that we all talking about. There's a carbon sequestration, because the global politics has resulted into a carbon market. We don't have a market for biodiversity. We don't have market for water restoration. We don't have market for outcomes of community resilience building, right? These are all factors to that. So suppose that you have a biodiversity offset or credit market that is enforced by the government. Then once somebody knows that if I generate this particular outcome, somebody pays for that, the commercial investor come. What Arti was talking about, we have now a clear market that if you get a certificate that you have reduced 1 ton of carbon emission, then somebody is willing to pay. Now, there are different ways you are trying to reduce the uncertainty. So, having these outcome markets developed is one way to do that. And this could be developed nationally, this could be developed internationally. Right now, we have a carbon, but technically, we can have for water, we can have for biodiversity, and those would unlock different segments of resource market. So that's insurance, and then outcome market. The third is having a clear template for financing. The bankers often are not shying away from financing. They just don't understand the economics. I have been training bankers, and bankers say that, okay, I know that these agroforestry project would have some carbon coming to that, but where do I factor in the carbon in my balance sheet? How to treat carbon revenue, which is very uncertain, the prices move, the production moves, and if I take the carbon credit, I don't know what kind of asset it is. Can I take carbon credit collateral? I don't know, right? So that's another case, training the bankers for this project. So we have often ignored the role of financial last mile to play in this. Bankers, if you talk about a banker that what is restoration project, I doubt that they would be there. But you talk about them a solar project, they can say that, okay, this is the economics for that. So that's the third layer, building capacity. The fourth innovation, I would say the DMRV, I won't go into that. This is a problem that could be easily solved with technology. It's a 3-year, 4-year problem. I won't say it's a fundamentally a long problem. We are already close to solving it. But the innovation that I want to see is that how you can aggregate. Aggregation has been a challenge. Arti and several others were trying to aggregate smallholder farmers, but in the global south, where the land holdings are 1 acre to 2 acre, how can you create economics? I just want to highlight that the registration project share a lot of similarity with infrastructure financing. 10-year, 20-year, that kind of horizon, critical for country. And unfortunately, they have also one peculiarity that completely differs. Infrastructure projects are very large and very centralized. One contractor getting a contract for 3,000 crore, 10,000 crore. On the flip, registration projects are, you're talking about 50 crore, 100 crore, on the large side. Otherwise, you're talking about a farmer seeking loan for 20,000 rupees to restore something. That basically requires a very different kind of thinking. And I like the point about templates. Restoration projects need to start with having a clear methodology that how they would be assessed for their benefits, how they would be priced, factored in for their revenues, and how they would be assessed for their return. There are 3 examples I want to quote. Ecuador has done a lot of work, and I don't know, if, there is a very exotic term called debt swap for nature. I'm not sure if you have heard this. What Ecuador was having $1.4 billion of debt, they were not able to service, and they were almost in doldrums. Somebody bought that debt, put into SPV, provided guarantee to increase the rating of the SPV, and then reduce the interest rate on that. And $18 million was unlocked for restoration. This is a pure play case. I'm saying that. I just want to highlight this, that there are several financial engineering can be done to do that. We have 2-3 examples in India. We have done sustainability linked bonds. We have done green bonds. We are talking about adaptation focus, where you give loan to a corporate, and then if they meet certain adaptation categories, the interest rate goes down. Value chain financing, there are, for audience, if you are interested, there is a big initiative you should be aware of. It's called INI, International Insetting Network. This is backed by the global corporates like Kering, Pepsi, etc. They have come together to pool the money, to invest into their value chain, to make their value chain more sustainable and to restore that. And it's one of the largest globally there. So I'm not talking about offsetting, I'm talking about insetting. Offsetting is what Arti is doing. Insetting is that I do it in value chain. Last example, I would say that this year there was a major success that happened in the COP biodiversity, not the COP, the climate change one, the biodiversity one. It's called Cali Fund, C-A-L-I Fund, Cali Fund. This is a very unique thing. Cali Fund basically pulls money from all the corporates whose business depend on biodiversity, land, water, restoration, etc. And they said, put the money there, and they designed the fund in a way that 50% of the money would be directly going to the communities which are working in those value chains to restore. So it's a pretty at large scale trying to see that how we can do that. So to conclude, there are lots of innovation happening in de-risking the sectors. There are a lot of innovation happening how to structure these projects. There are a lot of innovation happening how to get the different kind of capital flow. But these are very exotic yet. They are not mainstream. So we need to highlight those learnings. We need to highlight those success stories, and then we can move on.
Fabulous. Valid points, and I think I totally resonate with some of the examples, because that's actually the work that we've been doing at Villgro as well, to look at de-risking some of these transactions, and that's where when we talked about CSR also, how do we use CSR to actually de-risk to attract commercial capital? So these are the kind of structures that are actually in place right now, where we are able to attract commercial capital, for restoration projects. But moving to you, Arti, I think you have, very clear examples of aligning community and ecological outcomes, right? So I would like to understand, what are the kind of models that you've, experimented with, what have worked in terms of like outcome-based financing, carbon credit-related projects, right, and any other corporate partnerships, right? What was successful, what didn't work, a little, insight into that.
Sure. So maybe I'll preface, and it might be useful context, I'll preface the response by first saying that, so at Farmers for Forests, we use the payment for ecosystem services model, and that we use regardless of the way the rural agroforestry project is being funded, right? So what it essentially means is that we provide a farmer like a payment, a results-based payment, an annual payment, which is contingent on them, guaranteeing a minimum percentage of survival on their land. It's by design a modest payment. It's not meant to replace the income they'll get from the trees. The income increase from the agroforestry harvest is significant. We've seen at a minimum 3 to 4x increase from what they were doing previously. So the payments are modest, and it's essentially, it acts as a bridge, right, between when they're transitioning from, is maybe monocropping to agroforestry. It's a bridge for the first few years where they're getting no income. I should also caveat this by saying that It's more like we use it as almost like a behavioral kind of tool. It's essentially to bring in alignment between the farmers and us that, look, the survival of trees is important. Because one thing we've noticed is that farmers value, from our experience, the tangible inputs that they're getting from us, the saplings, the compost, the drip irrigation, the organic fertilizer. Like for them, they understand that value of that a lot more than like an abstract carbon payment or any kind of payment, a PES payment that will come at some point. So I just want to caveat all of this by first saying that. In terms of like the different forms of financing and how it has helped, I think we need to, at least at Farmers for Forests, have to give a lot of credit to philanthropy. They helped us a lot, especially the first few years. It was only because of philanthropic capital that we could develop a proof of concept. The first couple of years when we were trying different models, our survival rates were 20%. They were dismal because we were trying all kinds of different things. It was a lot of trial and error. It was because of philanthropy that we were able to come up with a scalable model that didn't compromise too much on quality. So I think that's purely due to philanthropy. We still rely on philanthropy a lot. Like we kind of consider it almost like an R&D capital, because no other form of funding will help us fund that. Like philanthropy has helped us, do interesting things around like introducing, Gliricidia hedgerows to improve nitrogen. It has helped us like, experiment with different like species mix. It helped us develop our entire tech stack, our entire digital MRV. We could build a tech team because of philanthropy. We built a tech team that essentially, used open source Python packages and computer vision libraries and completely retrained it on the tropical, subtropical landscapes of India to essentially be able to now granularly, like at a tree level, geotag each tree on our plot and measure the carbon of each tree on our plot. Like all of that is purely philanthropy. So, so I guess the credit lies to philanthropy a lot. I think carbon finance for us has enormous potential because it gives us something that other forms of funding does not, which is scale. Like we can work with one carbon funder and essentially implement our model across 20,000 hectares. For us to cover 20,000 hectares, we'll probably have to work with 20, 30 different funders otherwise. So it gives us scale. But I think, as I mentioned, there are a few different considerations with carbon financing. One is that with carbon financing, because the focus is so much on the carbon bit, there is a trade-off in biodiversity. We've seen it ourselves. Carbon funders want very predictable, steep carbon curves, which means that we will sometimes have to compromise on the biodiversity bit. Like I don't know if there's any carbon funder in the room, but if they had it, they would, if they had the choice, they would only make us plant like mango and lemon tree species because they grow really fast and farmers love them because they give you an income. So the chances of them dying or being replaced are very low. So there is that bit about carbon financing. I think the other point I've already mentioned, which is like risk sharing, needs to be a lot more fair and a lot more carbon funding, carbon revenue needs to go back to the communities. So I think keeping all of those caveats in mind, I think carbon financing is a great thing, but it needs a lot more reform, which I think is happening right now. It's actually, I can definitely see every year strengthening of protocols and methodology. I just want to say one thing here about the carbon financing, which we've observed with our work, is that CSR actually played a great, like an enablement role here, because we have done like small projects through CSR, where we were, either strengthening nursery systems or we were training our field team. We've done these small projects in communities. So once carbon funding comes in, we are like ready. We are at capacity because we've gone through that initial, kind of like training ground with CSR funding. So I think CSR funding is a great enablement to scale.
Yeah, I remember Villgro, you worked with Villgro as well in one of our CSR projects. So yes, yes, absolutely right. Arun, I'll come to you now, and maybe I would like to hear from you on some of the examples of innovative financing structures that you have seen, where the structures have helped to kind of reduce the risk, or and hence channel the money towards restoration projects. So, some of those examples of risk sharing that you've come across.
Yeah. Again, taking a step back, I was just thinking that I have a hard time imagining a SBA or something giving a loan for restoration projects, right? And that is, I think, a fundamental problem. Because, and this is because, one is, of course, retail banks are quite conservative in India, but also because I think in this sector, the taxonomy, the MRV methodology, etc., needs to be standardized. And in India, standardization more often than not means that the government has to announce these things, right? So if the government is actually proactively, if it can define the scope, the standards, the auditing mechanisms, etc., for restoration projects, I think you will see much more capital coming in. But even when that happens, I have a hard time imagining retail banks funding it. So it will have to be through these windows, these facilities, etc., which has been set up by, let's say, a NABARD, for example, or any of these other development banks or specific funds set up by the government, which can then pool in capital from multiple sources. Having said that, so one of the projects which WRA is doing is the Harit Bharat Fund, which is basically for greening or restoring of land. And the idea is that a large component of that would be, of course, grant, but there's a small component which is in loans as well, right? And for loans, what was really challenging was how do you actually attract some financier who will lend for this cause. And so we had to work with, we had to bounce off a few ideas of Villgro, you as well, to set up this credit guarantee. And again, it was a process of discovery that even setting up a credit guarantee is quite challenging in India, right? So if it is backed by, again, if a government entity does it, it might be easier, but for private entity, it's almost close to impossible. And even when the government entity does it, after the RBI announcement about credit guarantees, it becomes a one-on-one kind of credit guarantee, right? You can't really leverage it. So I think, we did that. We set up the credit guarantee. The first loan has been given. But I think there will be a lot of benefit if the regulators and the government kind of standardized it. And it need not be only for restoration, it has to be across sectors as well. And the government has a role to play in this. Complementary to this is also developing the technology for auditing, right? Because restoration is all about volume. Unit economics matters. So we have developed a technology called TerraMatch, which basically takes satellite photos and figures out how much of the land has been restored. And this helps with the volume, and this helps with the auditing mechanism, right? So I think I'm sure there are others as well who have developed such technologies, and those are complementary to whatever instruments, whatever financing is happening. So yeah, I think, time's up, but this is a concrete example. You can look up the Harit Bharat Fund. You can Google for it. You can look it up. We also do a landscape accelerator, which is more of an accelerator for developing enterprises which are present in this sector, and hopefully, providing them with an impetus for further equity funding, right? So that's another approach, and that approach I think works better in India because the regulatory challenges are much less, right? So these are two concrete examples I can give, yeah.
Can I add to just quickly to that? So just for those who are working on that, they can understand what are the options available. HSBC, Pollinate came together to set up a different vehicle called Climate Impact Partners. And there are many such examples where the large institution came together to do that, dedicated funds, and they are investing into this project. So that's one example. They do have window for project development as well, and then they come as a main investor. Apart from them, I think there are several corporates have formed the consortia to work in this. Symbiosis is one, which is Google, Microsoft, all of them come together. Econ, working with Plan Vivo, has got the new kind of standards which factors in the small landholders and ensure that 80 to 70% of the carbon revenue goes to the small landholder farmers. So a lot of innovation happening. Unfortunately, all the example that we are giving is coming because carbon sequestration has been monetized, okay? So the point, again and again, if you want to get registration to achieve that goal, you need to find out how to monetize biodiversity. When I say monetize, how to attach price and value to that, how to attach price and value to water conservation, how to attach price and value to community resilience. Otherwise, we'll keep on picking up examples from the carbon credit space.
No, no, absolutely. But, I would, I know we're out of time, but I would just like to take a minute to, also maybe give an example from my work at Villgro, right? And I think about 4 years ago, or 5 years ago, I think we had this startup which came into our portfolio, which was still working on, drone-based spectrometry, something to detect early pest infestation, reduce the amount of pesticides that went into it because of the early detection and all that. And we gave them a grant, to kind of perfect that technology. They needed money to kind of scale and, actually onboard farmers for their project. And that's when that was the first loan that we guaranteed. And it was a very, very tiny loan, 25 lakh rupees, right? It's nothing. But the impact of that loan was that, there was, I think, a 10x or a 20x in terms of, the business that grew, the follow-on funding that they were able to raise. And I think about a couple of months ago, they did their SME IPO, right? So when I look at the transition of capital, right, I think we all have to be cognizant that, every stage requires a certain type of capital. And we need to make sure that that matching of capital, the type of capital that happens, only then we are able to kind of really bring out more success stories for this sector. I'd like to kind of open, the stage for the audience. If you have any questions, happy to take them. Please be brief and just give your name, introduce yourself and ask the question briefly. It will be great.
Thank you. Hi, I'm Manika. My question is to Santosh. So, if you were to sum up, basically what return profiles, impact or financial would you see would make private investors invest more in next 2 to 3 years in NBS projects? Would be that.
It's a difficult question. I think it's not a straight answer, but depends on what the risk we see. And I give you an example of that. Sorry to give you an example, not a straight answer. Solar projects in India are attractive to investors if they make around 14 plus percentage of return, right? Same are attractive in Germany if they make 7%. In Argentina, nobody will touch them, the same project, if they make less than 50%. So the risk-reward ratio is the key that we're looking for. But since you made the word impact investors, there are a whole different kind of them. So many of them could just saying that, I just want my money to come back. I don't seek any return. Somebody would say that, I just want to showcase that you have solved a problem and I want to burn the money. So as he was pointing it out, at different stage of the project cycle of the institution, you require different kind of impact capital. That could be a guarantee, a product testing grant, or a scalable capital. Ideally, you should have the clarity that I have a thesis that for this particular project, this is how the scale would look like. I will never go to a scale that I would be giving 20% return. So you are very clear that I'm going in this direction. And once we see that, what impact you are trying to create, then the returns are basically factored in that way. So there are examples of many cause-focused funds which are dirt cheap, right? And then same examples, impact-focused funds where very almost touching on the commercial capital. The green bonds, if anybody looking for that, greenium is no longer exist. It's like almost, so I would say that look at the project and see how the scale would achieve and see that what kind of problem you are trying to solve. And for that problem, do you have a different kind of capital available?
And I think to add on to that, so you were talking about monetizing and attaching a monetary value, right, for ecosystem services and so on. So unless that happens, I mean, I don't think, you're getting into the sector saying, I'm going to get 15% return on my equity or whatever, right? You're going to see people who are interested. It may be impact investors who invest in that thematic area. It may be, development finance institutions, which might be okay with what they think is the market return, not what equity investor thinks is a market return. So these kinds of investors you will see, and they will do their own math and they will calculate that, okay, this is the return I'm getting, and I'm fine with that. But if you're actually if you're asking the question, what is the return expectation? It sounds like, okay, the market is semi-mature or mature, and equity investors know what they're getting into, right? That's not the case here.
One last question, maybe?
Hi, I'm Ashish. I'm from Plowman Agro. It's a small agri-business startup. So my question is about the debt funding. Debt funding in India is costly. It's and not easily available, and also for a small startup, you also need to give a lot of collateral and all. So for a green business, and do you have any product which, just because it is green, it gives some interest subvention or maybe an interest concession, and also concession like in terms of less collateral, kind of liberal repayment period, better drawing power, all of this, because these are really the big constraints for any startup to make impact in green business or enter into green business. It's not easy.
I mean, if I could also, take a stab at that. Yep. So, and only because, I ran this program last year, and also it's a continuous facility that, is now being run at Villgro, right? We did exactly that. The objective is to transition businesses from, that grant stage to commercial capital stage, and the role of the guarantee is to de-risk that first loan to the startup, where collateral is not available, right? Where, it is like a small value, hence, it may not make economic sense for the banks. That was a product we did. We got the guarantee through CSR funding, and we got like an 8x leverage in terms of whatever was the CSR funding we put up for guarantee to unlock loans for about 13 or 14, I think, startups working in this space. Second, we are also, within Villgro, we have the product where based on impact milestones that are achieved, specifically related to, whatever is the impact thematic area that we are having. So in this case, it is regenerative ag. There are interest subventions that also are offered to make sure that the loan becomes affordable. And we bring in financial institutions to do this, right? So that we are aligned, all parties, whether it is the financier, whether it's the philanthropy, the entrepreneur support organization, as well as the enterprise, all of them are working towards a common goal. So at least at Villgro, we have that product. So if you're a for-profit company, please reach out. We'll definitely see how we can support you.
And there is also, NABARD has a facility called NGLF, NABARD Green Lending Facility. And they are coming with an agri-focused fund. So exactly what you're talking about is there. You can get a very affordable capital with a lot of freedom, the way you are asking about. Also, just for everyone, when I talk about climate finance, you guys should focus on that. Climate finance, in a classical sense, is a grant money from the developed countries to developing nation, and those capital, if flows, solves the problem of this cost of capital and that. But unfortunately, we often speak about financing the climate and not climate finance. So any climate finance that flows through NABARD or something, that could address the cost of capital problem.
Right. Thank you, audience. And we'll maybe close the panel with a quick question, one-line answers from all of you. What should we do next year to get more private capital to enter, restoration projects and the sector?
I guess I'll just summarize everything I said, which is essentially financing that aligns with ecological timeframes, models that don't push risk and liability all to the smaller organizations, and then really figuring out ways to maximize real value for communities and to reward them fairly for the climate services that they're providing.
I would just say that with the pools of capital there, ask them to have a dedicated facility for this. Unless you have a dedicated focus on this, the sector will not develop. If a fund manager, an institution having multiple agenda point, it will never happen. IREDA is a good example. IREDA, we did not have problem after the no financier. We wanted somebody to just focus on renewable energy, and you can see the result. So we need an institution that focuses on restoration, and that would help it there.
I think the immediate next step can be, I'm a big proponent of creating project pipelines and matching capital with project, right? So a lot of these projects can be, might be eligible for funding if only investors have visibility on the projects, right? So create a big pipeline, showcase to impact investors, showcase to anyone else who is interested, DFIs, etc., and matchmake is what I would say.
Fabulous. So thank you very much. It has been a very interesting panel, and thank you, audience. You've been fabulous. Thank you.
Thank you to our moderator, Vibha, and our panelists, Santosh, Arti, and Arun, for their valuable insights and time. And also really grateful to the audience for their questions. And clearly, the takeaways, I think, have been very well summarized already. Restoration is definitely durable and investable. Collaboration and innovative financing can unlock next wave of impact, but these ideas need to be mainstream. And if we align capital and with climate and community needs, restoration can clearly become one of the most exciting investment opportunities of this decade. We encourage everyone to keep these conversations going. Let these not end with this session. We can, please feel free to also continue beyond this room.